What's up, everybody? Welcome back to another video. It's been a while, I know, and people have been telling me that my videos are too long. I know the last couple of videos lasted more than an hour or 45 minutes something. I know I always tend to get into explaining my thought process, giving you a lot of background information, but most of you don't have that much time, so I try to improve on that. Speak faster, think faster. So let's get into the stock today. I want to talk about Teekay LNG Partners. It is a gas shipping company. And yeah, a lot of things going on in the commodity sector right now. Teekay Partners is one of the biggest players in the market worldwide. I think they're number 3. They have around about 60 vessels, middle-aged vessels, just for gas shipping. So you got LNG, you got LPG, whatever, different sort of ships, different sizes of ships. And so they are in the business of shipping gas from one place to another. So what happened with the stock? I've been a shareholder since the stock price was at 13, so I did pretty well until now, and the stock price is at 17.13 at the moment. It has been on 17.10 over the past week. Why is that? Because they received a takeover bid from Stonepeak. They want to buy the firm for $1.5 billion. My opinion on this deal, it's a crappy deal for shareholders. It is a super deal for Stonepeak. So there will be a vote on this takeover bid, and I hope that the shareholders vote against. And I will explain to you why that is. So let's look at the chart real quick. We see that commodities and shipping business is very cyclical. You can see that on the chart. You don't have to be a genius. But what is important is that we entered a commodity super cycle in 2010, 2011, and we see what happened here. The spot rates went up. Teekay Partners was making a lot of money. The share price rose to 45. After the super cycle declined, it dropped to as low as, oh my God, $9. So it has been a very painful period if you entered here as a shareholder and you're still waiting, right, on things to improve. And this really, really sucks. So, and now Stonepeak comes in and wants to buy the company for $1.5 billion or $17 per share. If you're into commodities a little bit, then you might have heard rumors about that we are on the verge of a next commodity super cycle because of inflation, because of supply chain issues, because of the economy taking up speed again. So we might see prices increase a lot, and we already do, especially gas prices. But the freight rates are not as attractive as they used to be at a first glance. But there's some things going on, and I will explain to you shortly why that is. So what I think of the deal is now Stonepeak comes along trying to buy the company out of $17 a share. So basically buying the golden cow without paying for the gold. And if we are entering a new super cycle, the stock price will go up again because fundamentals really didn't change that much for Teekay LNG Partners in the past. Same amount of ships, highly leveraged. Basically, it's the same company right now, only the stock price is down also because of the ESG fad and so on. So nobody likes dirty tanker ships. I know, it's boring. It's not super sexy. It's not Tesla. I don't know when we will have electric ships, but that's another story. So right now, stock is undervalued. And I want to show you why. Because if we look at the company and the fundamentals themselves, we have a super high operating margin of 45%. We have a net margin of 35%. So every dollar we make in revenue, we keep 36 cents net. This is a hell of a business if things are good. Those tanker companies also tend to use a lot of money when the spot rates are down. But the thing is, you can have long periods of losing money, and when spot prices go up, you will just make so much profit that the past years with losses just don't count. You just overcompensate with a lot of money. But Teekay is structured conservatively because they are into time charter contracts. So their fleet, their vessels are booked out over long periods of time. Prices are locked in, which is good, pretty conservative for the business. And they are not exposed to that much risk of up and down spot rates on the market. So just a little background info on the company's fundamentals here. But we see it's all nice and green, and compared to the industry, it's even super green. When we look here, the current share price is trading for a price earnings ratio of almost 8. The price book ratio is not even 1. And we have dividend payments of over 6%, 6.3. Other sources say 6.5%. So you get a lot of money just by holding the share without even doing anything. And what we see here, and the first thing that makes me think that the deal is crappy, is we have a tangible book value of 20 per share. So basically, this is a proxy for if you liquidate the company right now and everything is sold for book value and all the liabilities are paid and so on, you get $20 a share. And now there's Stonepeak wanting to buy the company for $17. Let me repeat, $17. This is $3 discount on the share just compared to tangible book value. And we know that super high or capital intensive fleets also provide a substantial value or substance value, right? And why would you sell something that is worth $20 for 17? This doesn't make sense. Totally ignoring that there's a profitable business underlying in the share. It doesn't make sense to me, but more on that later. If you want to go deeper into the tanker business, understand the vocabulary here, wrap your head around the business, let me show you some sources. I will post a link in the description below. But those are articles that I find very, very informative, and that give you a very easy entrance into the shipping market, and especially when we talk about gas tankers. So Ashland hates investments. The cash flow area begins for TK Partners. Article January 2021. I don't know why they don't sell those cash flows to Stonepeak, but different story. Voyage charter versus time charter, explaining differences between the spot rates and what's important for TK, since they have a lot of vessels locked into time charter contracts. LNG transport, an article right here, Hellenic Shipping News, where the big money is. It is in LNG transport, apparently. And this is a very nice article, also very up-to-date article, and very well written if you are also interested in other shipping sectors. Amidst the power crisis, Greg Miller describes how the power crisis affects container shipping, dry bulk shipping, and gas shipping. Here we are. And he's also explaining to you why time charter rates are down or spot rates aren't up more, but there's a lot of things happening in the gas shipping market, and now you get out of my face here. Also, gas tanker fleets are not growing as much as container fleets, dry bulker fleets, oil vessel fleets. Gas tankers will be pretty much stable. So locked in supply, demand is the crucial factor, and this will go up because the gas market will double from now until 2014. You can also watch some market reports on that. So a lot of things going on there. And I think if you pick a shipping industry right now before a maybe happening super cycle, I would just go into the gas tanker stuff. Yes, so fundamentals are good. Company's profitable. Book value $20, and now we're talking about a takeover bid of $17 a share. I can only recommend to read the Seeking Alpha article by Pedro de Norona. He's explaining in detail what is in my head. I couldn't have done it better. I really like the article because he also holds management accountable for what they said in the past. And he's also pointing out that maybe management has received some incentives to tell you right now, well, the $17 takeover bid is very good for shareholders. It's a fair price. When 6 months ago, you said the exact opposite, that the price is down, the company's undervalued, things are looking good, things will get back if valuation gets back to peer valuations, to 25 or $30 a unit. That's what they said. Okay, it's been 2 years, whatever. And now all of a sudden 17 is a good price right in front of a potential new super cycle. Like, get the hell out of here. Something is fishy about that deal, and if you are a shareholder, you should vote no on that deal or ask for a higher price, at least $25. That's what I would ask for if I was still a stockholder. So look at the description below. I will post a link to that article. It's really, really good. And Pedro explains why this deal is just crappy. How can you trade that? I went from being a shareholder to being an options holder. So I bought the share at around $13. I sold it at 17 because the price is locked in right now because the takeover bid is there. So what can happen? And I will show you my idea. If you want to take on some risk, you have to look at the options. So if I look at the options for May 2022, let's look at a strike price of 15, bid price 2, ask price 5. So huge spread. I bought the options last week for $2.40, which means the stock price is locked at $17.10, and I buy an in-the-money options with the strike of 15. I'm already in the money, $2.10. So I paid a premium of 30 cents per contract on these options that are running for 8 months. So what's the idea behind it? If there are 3 scenarios in my head. Scenario 1, the deal goes bust. We don't know what happens with the share price if it goes down, but I don't think so. If the deal goes bust and shareholders decline and Stonepeak says, well, we just get the hell out of here, what can happen from there? It can happen that somebody else is making a bid of a takeover bid with a higher price. It can also be that nothing happens and the stock price goes back to lower levels, but I think it goes back to higher levels. But the risk here is volatility, and you don't know how it plays out over which time. So options might be risky here. Scenario number 2, pretty stupid case, but it limits your downside. The deal gets approved by shareholders and the company gets bought out by for $17. So you end up with in the money options for $2. So what you lost is the 30 or 40 cents premium. If you get the same price as I did, if I look at the spread right here, I think that the options will sell for a higher price right now. But the downside is limited. That's what I want to say. If the deal goes through, you only lose the premiums. You keep the amount in the money, and you didn't win anything, but you didn't lose much. But here comes the Big Mac. If the shareholders vote no, and they improve their offer, and let's say they go up to $20, $25, then the options will just go up. And the price is locked in there. And if the deal gets approved here, then you have made a nice trade. So you can say you invest $250 or $240 in the options right now, and you end up with 5, right? So you have made 100% profit on your options, which is nice. But let's look at that. If we say the downside protection at 17 is there, you just place $2 in the options and pay 30-40 cents premium. So to keep it simple, if the company gets bought out for $20, you're already 2 in the money. You pay a 30 cents premium, and then you get an additional $3. You have made tenfold on the premium that you paid. So if we assume that the stock doesn't go down and the downside is limited by 17, the only thing you have to take care about is the premium. And if this is a 10-bagger, then this was a very, very nice deal from that perspective. Just let me know what you think about it. This is my trade idea. This is what's going on in my head with this company. If you are getting into the gas tanker stuff and you like it, and if you want to be a shareholder, you can look at Flex LNG. John Frederickson went public in 2019. Most modern gas tanker fleet in the market. So this is something I can also recommend. Paying high dividend, basically the same thing as Teekay LNG Partners, but still available and very attractive stock. Let me know what you think about it in the comments. Read the description for the links and get into it. I want you all to have a super nice weekend. Take care and see you all next time.